Imagine this for a second. You are sitting at your desk.
Yeah.
The room is completely quiet, the coffee in your mug is still hot, and you are staring dead ahead at your dual monitors.
We've all been there.
Right. And on the left screen, your 5-minute chart is just absolutely screaming at you. I mean, the candles are thick in green, the momentum is surging upward, and every single oscillator you have loaded up is aggressively flashing a buy signal.
Oh, yeah. Your pulse quickens.
Exactly. You feel that familiar tightening in your chest, the opportunity is right there. But then you glance over to your right screen, you've got the 1-hour chart pulled up over there, and it is telling a completely different, almost terrifying story.
It looks incredibly heavy.
So heavy. Price is just slamming into this massive ceiling of historical resistance. A long, ugly wick is forming, violently flashing sell.
It's the ultimate paradox of modern trading. I mean, you are looking at the exact same asset at the exact same moment in time, yet you're being handed two completely opposite narratives.
And what happens to you in that exact moment? You just sit there, caught right in the middle. Your hand is literally hovering over the mouse.
Yeah, the physical anxiety starts creeping in.
Right. Your brain is desperately trying to reconcile this massive contradiction. You start asking yourself the ultimate question, like, which one of these charts is lying to me?
Is the 5-minute a fake out? Is the 1 hour just lagging?
Exactly. You feel like this detective trying to catch a suspect in a lie, but the tension is agonizing because, well, you can't put your capital on the line until you figure out who the liar is.
And that tension, that specific feeling, is exactly why so many traders ultimately fail.
Wow, really? Just that feeling?
Yeah, because they are paralyzed by an environment they fundamentally misunderstand. Because here is the harsh reality that most platforms and educators will just never tell you. Neither of those charts is lying.
Wait, neither of them?
Neither of them. They're both telling the exact objective truth about what has occurred.
But your brain is being completely tricked by an illusion. Which brings us to the core of things. Welcome to today's deep dive. Today, we are completely dismantling one of the most fundamental, unquestioned elements of trading, investing, and just market analysis in general, the time frame.
It really is an illusion.
We're going to explore why the very concept of a 1-minute market or a daily market is a complete abstraction. It is a ghost. I mean, it doesn't actually exist.
It is perhaps the most pervasive illusion in financial markets today. And what is truly dangerous about it is that it is entirely manufactured by the very tools we use to look at the market.
The software itself.
Exactly. The software creates the cognitive trap.
So our mission for this deep dive is to fundamentally shift your mindset. We want to move you away from chart-based thinking, where you are basically a prisoner to the pixels on your screen, and guide you toward process-based mastery.
Which is a huge shift.
It is. We are going to decode how these timeframes actually work beneath the hood, the specific psychological traps they set for you, and how to organize this massive, continuous flow of market data so you can finally eliminate that paralyzing feeling of staring at conflicting screens.
So let's zoom out for a second.
Yeah, let's do that. We have to start by examining the foundation of how traders are educated and onboarded into this whole industry.
Like day one stuff.
Day one. Think about the very first time you ever opened a charting platform, whether it was TradingView or a brokerage app. What actually happens?
Well, there's a lot of flashing lights usually.
Right. But the very first thing your eyes are drawn to is a row of buttons at the top of the screen. 1 minute, 5 minute, 15 minute, 1 hour, daily, weekly.
Oh yeah, the time frames. They are front and center.
Exactly. Before you even understand what a bid or an ask is, you are conditioned to segment the market into these rigid, predefined buckets. It is just presented as the default state of reality. You don't even question it. I mean, it would be like questioning why a steering wheel is round. It's just how the software works.
But over time, as a trader stares at these different screens day in and day out, a subtle but really profound distortion occurs in their psychology.
What kind of distortion?
Well, these time frames stop being viewed simply as software features or data filters. They start being treated as entirely different realities.
Like totally separate worlds.
Yes, as competing truths that exist completely independently of one another.
You know, I've heard people talk exactly like this. A trader looks at that 5-minute chart, sees the price going up, and literally says out loud, the 5-minute market is bullish right now.
Yep.
And then they look at the 1-hour chart, see it trending down, and say, but the 1-hour market is bearish.
Notice the language there. The 5-minute market. The 1-hour market. They talk about them as if they are separate physical locations.
Oh, that's so true.
As if the 5-minute market is happening in New York and the 1-hour market is happening in London, and they're experiencing completely different weather patterns.
Right. Right.
And this creates the most dangerous trap in multi-time frame analysis, the desperate pursuit of alignment.
Let me make sure I'm wrapping my head around this. If I believe the 5 minute is one physical reality and the 1 hour is a competing physical reality, my brain instantly decides I cannot make a move until they agree with each other.
Exactly. You need them to align.
I need the weather in New York to match the weather in London.
And waiting for that perfect alignment leads directly to delayed decisions, missed opportunities, and just deep systemic confusion.
Because it's a false premise to begin with.
It is a complete fallacy.
Yeah.
The underlying assumption driving that behavior, that time frames represent something tangible and independent about the market itself, is just totally wrong.
There are not multiple markets.
No. There's no 5-minute market. There is no 1-hour market. There is only one continuous, unbroken river of transactions.
Let me try to build a mental model here for us. Let's use the concept of a house. Is this basically like standing in the exact same house looking out of two different windows?
I like that. Let's run with it.
Okay, so the 5-minute chart is the small window in the kitchen looking out at the bird feeder, and the 1 hour chart is the big bay window in the living room looking at the entire street.
Spot on.
Because the view from the kitchen window is slightly different from the living room window, I'm sitting there assuming I'm looking at two entirely different cities.
That is a phenomenal way to visualize it.
Yeah.
You were in the exact same house. You were looking at the exact same physical landscape. But the frame of the window simply restricts what you were able to see.
The market is the landscape.
Yes, the market is the landscape. The time frame is just the frame of the window.
So what actually happens to our decision-making process when we sit there sprinting back and forth between the kitchen window and the living room window, waiting for the bird feeder and the entire street to look completely identical?
You freeze. You experience total cognitive overload and analysis paralysis.
Oh, man, yeah.
You basically wait for the sun to hit the bird feeder at the exact same angle it hits the street before you decide to step outside.
Which might never happen.
Right. And while you are running back and forth, checking the windows, stressing over the alignment, the storm passes, the sun comes out, goes down, and you have missed the entire day.
Have you ever waited for perfect alignment across all your charts, only to watch the perfect explosive opportunity pass you by completely?
I think every trader has.
I can feel the collective sigh of every listener right now. Anyone who has spent more than a week looking at financial markets has felt that specific agonizing pain.
It is the worst feeling.
It is. You sit on your hands, you wait, you finally get everything perfectly aligned. The 1 minute is trending, the 5 minute crosses over, the 1 hour closes bullish.
Everything looks perfect.
Right. You get that huge rush of dopamine because you solved the puzzle. And the very second you hit the buy button, the market immediately reverses and stops you out.
And there is a real mechanical reason for that. By the time all those arbitrary windows show the exact same picture, the underlying market process that was driving the move has already exhausted itself.
Wait, really? Because it took too long?
Think about what price actually is. Price is not a line on a chart. Price is a continuous flow of bids and asks.
Okay.
It is buyers and sellers interacting with an order book at an exchange, executing physical transactions. That river of transactions does not have a clock.
Right. It doesn't care what time it is?
Exactly. The order book at the Chicago Mercantile Exchange does not know what a 5-minute candle is. It doesn't stop, take a breath, and reset at the top of the hour.
Now, here's where it gets interesting. If the underlying market engine, the actual matching of buyers and sellers, doesn't know what these time frames are, what exactly are we looking at when we select one on our software? What is actually rendering on our screen?
You are looking at a sampling
A
mechanism.
sampling mechanism.
Yes. A time frame does not alter price. It does not alter liquidity. It does not change the actual behavior of the institutions, algorithms, and retail traders interacting in the market.
So what does it do?
All a time frame does is organize historical data. It is a method of compressing a continuous stream of transactional chaos into fixed, entirely arbitrary intervals.
Oh, I see. It's essentially just drawing a box around a certain amount of time and telling the software, like, hey, I don't want to see every single tick. Just give me a mathematical summary of what happened inside this box.
Precisely. Let's really break down this data compression, because understanding this removes the magic from the candlesticks.
Let's do it.
Think about a typical daily chart. An entire trading session is incredibly chaotic, right?
Oh, absolutely.
Over the course of 24 hours, you have macroeconomic news releases that cause massive volatility spikes. You have high-frequency algorithmic sweeps hunting for liquidity.
Yeah, stops getting run.
Exactly. You have periods of dead silence during the Asian session.
Yeah.
You have massive block trades from institutions rebalancing portfolios. It is a messy, violent, unpredictable process.
Total chaos.
But the daily chart takes all of that chaos, smooths it out, and presents you with a single, clean, vertical bar.
Just one bar.
One bar. Gives you 4 data points, an open, a high, a low, and a close. The market didn't suddenly become clean and orderly, only the visibility of its structure changed.
So it's pure data compression. We are just changing the resolution settings on reality.
And it's a great way to put it.
That makes me think of digital photography. Let's say I have this beautiful 8K high-resolution photograph of a sprawling, healthy green forest.
Okay, I'm with you.
If I zoom in 500% on a single green leaf on one single tree, I'm just going to see a bunch of jagged, chaotic green pixels.
Yes, you lose the forest.
Completely. I lose the context of the forest entirely. I might think I'm looking at a green wall or like a green abstract painting. So FAC is looking at a 1-minute chart, essentially just staring at the jagged pixels and completely losing sight of the actual picture.
That is exactly what it is. And this introduces a massive behavioral hurdle that we can call the distortion effect.
The distortion effect, explain that.
Well, when you zoom in on a photograph, the pixels look enormous. They take up your entire field of vision. When you look at a 1-minute chart, a tiny little fluctuation in price suddenly looks like a massive, terrifying plunge.
I do this. I have to admit, I do this all the time.
Most people do.
I'll take a position based on a really solid macro thesis, and then I'll pull up the lower time frame to, monitor it. And a 10-cent drop in price looks like the market is fundamentally crashing because that red candle fills up my entire monitor from top to bottom.
Yes, and your physiological response to that visual stimulus is very real. Your heart rate goes up, right?
Oh, instantly.
Because a beautiful, clean upward trend that is perfectly healthy on a higher resolution, like a daily or weekly chart, will look like a series of erratic, violent, and terrifying swings on a lower resolution.
The pixels look scary.
Exactly. Small movements suddenly appear massive and highly significant. The software alters your perception of reality, even though the underlying reality hasn't changed by a single cent.
This explains so much about the emotional roller coaster of trading. I mean, it explains exactly why a listener might feel their stomach drop, why they get clammy hands and feel totally panicked watching a lower time frame, even when the broader macro trend they invested in is perfectly intact.
Yes, you are reacting emotionally to the size of the pixels, not the reality of the picture.
And if we step back and connect this to the bigger picture of why traders fail, it becomes painfully clear why people get shaken out of perfectly good positions.
It happens every single day. Let's talk about Dave.
Okay, let's talk about Dave.
Dave enters a trade based on the beautiful, healthy green forest he saw on the daily chart. He buys in, totally confident in the macro trend.
Smart move, Dave.
But then Dave makes the critical error of trying to manage that macro trade by staring at the jagged pixels on the 1-minute chart.
Oh no, Dave.
The distortion effect takes hold. He sees a high-frequency algorithm run a quick stop-loss sweep, a totally normal function of market liquidity that creates a massive red candle on the 1-minute chart.
Right, a totally normal pullback.
But the visual distortion causes his brain to panic. He assumes the trend is over, he hits sell, he takes a loss, and then an hour later, the market continues its upward march.
Without him.
Without him. His perception of reality was warped by the resolution setting.
Okay, I track with the pixels and the picture. But I want to push back on this. And I want to push back hard.
Bring it on.
Because there is a very common, deeply researched concept in technical analysis that seems to completely contradict what we're talking about right now. What about fractals?
Ah, the fractal argument. Let's unpack it.
We are constantly taught by books, by courses, by quantitative analysts that the market is fractal, meaning that the exact same geometric patterns appear across all scales of time.
That is the theory, yes.
Right, like a head and shoulders pattern looks exactly the same on a 1-minute chart as it does on a weekly chart. A bull flag is a bull flag, whether it takes 5 minutes to form or 5 months.
It is entirely true that market structure is broadly fractal. Human behavior, fear, greed, and algorithmic programming tend to leave similar geometric footprints regardless of the scale of observation.
Okay, so I'm not crazy.
No, you're not crazy. However, this is exactly where the context trap springs shut on so many retail traders.
Oh, so?
Just because a pattern looks identical geometrically does not mean it carries the same weight, significance, or predictive power.
But wait, why wouldn't it? If algorithms are programmed to recognize and trade those exact geometric fractals, and I see a 1-minute bull flag forming, I know the bots are going to buy it.
Not necessarily.
But if the geometry is exactly the same, shouldn't the trading logic apply equally across the board? A breakout is a breakout. If I front-run the 1-minute algorithm, I make money. Why is that wrong?
It's wrong because it fundamentally misunderstands market microstructure and liquidity. Size and shape are not the only variables.
Yeah.
Context is everything. I want you to think about what actually goes into creating a daily breakout pattern.
Okay, let's break it down.
A daily or weekly breakout requires days, weeks, or even months of accumulated capital flow.
Real money.
Huge money. It requires a sustained underlying macroeconomic narrative like shifting interest rates or a massive supply chain disruption.
Right, something driving the world.
Exactly. Most importantly, it requires major institutional participants, banks, hedge funds, sovereign wealth funds, committing real substantial volume to move the market.
Has a massive amount of financial weight behind it. It's a heavy move.
Massive weight. Now, contrast that with a 1-minute pattern. How is a 1-minute head and shoulders created?
Well, I assume just smaller trades.
It doesn't require a macro narrative. It might be created by a single algorithmic block trade. Or, even more commonly, it's created by a momentary lull in liquidity.
A lull, like no one is trading.
Right. A void in the order book, where just a few small retail market orders happen to push the price around briefly before the heavy volume returns.
Oh, wow.
So the geometry of the 1-minute pattern might look identical to the weekly pattern, but the physical, financial forces creating it are entirely different.
So expecting a 1-minute breakout to have the same follow-through, the same sustained momentum as a daily breakout. That's like expecting a tiny ripple in a rain puddle to have the exact same force as a tsunami, just because they both look like waves if you zoom in close enough.
That is exactly it. I love that puddle analogy. And trading that 1-minute puddle ripple by trying to front-run an algorithm is mostly a zero-sum game of high-frequency ping-pong. Yeah. By the time your retail platform renders the 1-minute breakout, the institutional high-frequency algorithm has already bought it, marked it up, and is currently selling it back to you. The slippage alone destroys your edge.
Wow. Okay, that makes a lot of sense. So this is why traditional multi-time frame analysis completely falls apart for so many people. They assume that a structural shift on a lower time frame, like a trendline break on a 5-minute chart, has the exact same implications as a structural shift on a weekly chart.
Yes. They expect every time frame to carry the same weight, and therefore they demand that every time frame aligns perfectly before they act.
Which we already established is a nightmare.
Exactly. But that is a mathematically unrealistic pursuit. Each chart is simply highlighting a different level of detail, a different volume footprint of the exact same continuous movement.
There aren't different realities.
No, they are just different zoom levels.
And because traders misinterpret these fractal patterns, they fall into the trap of trying to force rigid, clock-based timelines onto fluid, capital-driven market cycles.
That is perfectly stated. Market cycles are organic. They develop over days, weeks, or even months.
They take time.
They do. They are entirely driven by macroeconomic conditions, by central bank liquidity injections, by corporate earnings cycles, by massive shifts in global capital flows reacting to geopolitical events.
Really big, slow-moving stuff.
Huge stuff. I cannot stress this enough. These massive cycles are absolutely not bound to specific chart intervals.
The Federal Reserve doesn't care that your 4-hour candle is about to close.
They do not care. The Bank of Japan is not checking your 15-minute moving average before they intervene in the currency markets.
I mean, it sounds silly when you say it out loud.
It does. Yet, despite this obvious reality, traders fall into these incredibly rigid, self-imposed habits. They artificially assign permanent roles to their charts.
Oh, like assigning rules to them.
Yes, they will proudly declare rules like, okay, the daily chart dictates the overall trend, the 1-hour chart dictates the pullback, and the 15-minute chart dictates my specific entry.
I have heard that exact rule 1,000 times. It is taught in almost every beginner trading course on the internet. It's almost gospel at this point.
And while it can sometimes function as a useful heuristic, a mental set of training wheels, when you are first learning to organize data, it very quickly becomes a rigid intellectual prison.
How does it become a prison?
Because a market cycle is going to exist, breathe, and unfold, regardless of how you choose to visualize it on your specific screen.
It feels like we are trying to accurately measure the changing of the seasons, from winter to spring, Using a literal stopwatch? Doesn't reducing a massive global macro capital flow down to a specific minute-by-minute chart risk completely losing the entire plot of why the asset is moving in the first place?
It absolutely does.
Yeah.
Cycles are driven by narrative and capital,
Hmm.
not by the clock on the wall.
Right.
When you shrink a massive macro cycle down to a micro visualization, you inevitably overemphasize short-term noise.
You lose the big picture entirely.
You start making your financial decisions based on the turbulence of the airplane rather than the destination it is flying toward. You completely blind yourself to the broader context.
So if a major institution is accumulating a massive position in an asset over a 3-week period, they are looking at the average price over time. They are trying to build their position quietly.
Very quietly.
They aren't sweating or panicking because a 5-minute chart briefly broke a local trend line.
Not at all.
But the retail trader staring at that exact same 5-minute chart is having a literal panic attack and market selling their entire position directly into the hands of that accumulating institution.
Which brings us to the most insidious part of this entire illusion, the psychological toll of artificial precision.
I want to get into this.
We need to talk about what staring at these screens actually does to the human brain. Because timeframes don't just shape how you see the market visually. They violently shape how you behave in it.
Let's really get into that, because I know from personal experience sitting there staring at a ticking chart for hours on end, well, it alters your brain chemistry. It makes you impulsive. It makes you second-guess everything.
It absolutely does. We need to dive deep into the psychology of the zoom in.
The zoom in, okay.
Why are traders so drawn to the lower time frames in the first place? Why do we love the 1-minute and 5-minute charts?
Because things are happening fast.
That's part of it. But mostly, it's because they offer an incredibly seductive illusion of precision. They trick the human brain into a false sense of control.
It's the belief that if I just look closer, if I just get more granular data, I can find the perfect risk-free entry. I can snipe the exact bottom.
Exactly. It's the illusion of control. If you are watching a 1-minute chart, you feel like you are micromanaging the trade. You feel safer because you can see every single transaction, every single tick of the price.
But that feeling of safety is entirely false, isn't it?
It is worse than false. It is actively destructive.
Actively destructive. Wow.
In reality, what lower timeframes actually do is directly cause chronic overtrading.
Because there's so much to look at.
Because suddenly, when you have the resolution cranked up that high, every tiny ripple in price looks like a highly actionable wave. Every minor, meaningless fluctuation looks like a major macroeconomic reversal.
You lose your filter completely. You start reacting to everything. You become a hyper-reactive bundle of nerves jumping at shadows.
You become hyper-reactive, and it goes even deeper than just bad trading behavior. Over time, this constant interaction with low time frames starts to warp a trader's actual identity.
Wait, really? Identity? It sounds like what you're saying, people let software settings dictate their personality. Do traders actually tie their literal human identity to a software drop-down menu?
They absolutely do.
Yeah.
This is a massive issue in behavioral finance.
I'm fascinated. Give me an example.
Think about how traders introduce themselves in forums, on social media, or at conferences. They don't say, I am an investor who looks for asymmetric risk-reward profiles.
Right. Nobody talks like that.
They say, I'm a scalper. I'm an intraday trader. I'm a 5-minute momentum trader.
Wow. I am literally guilty of this. I have described myself that way.
See? They are defining themselves, their professional identity, not based on what the market is doing, not based on the underlying opportunity of the asset, but based solely on the arbitrary lens they chose to click on that morning.
That is profound. I am calling myself a 5-minute trader as if the 5-minute chart is a religion I belong to, as if it's my nationality.
And when your core identity becomes tied to the tool, you lose all cognitive flexibility.
You get locked in.
Yes. You are forced to find 5-minute setups, even when the market is clearly in a massive multi-day trending environment, where a swing trade would be significantly more profitable and less stressful.
Because if you don't trade the 5-minute, who even are you?
Exactly. By identifying as a scalper, you amplify the noise. You cause premature exits on trades that desperately need time and space to breathe.
Right.
And you create massive crushing anxiety when your chosen time frame conflicts with the broader reality of the market.
You are fighting the ocean because you decided to label yourself a puddle trader. You're out there with a teaspoon while a tsunami is coming in. So let me ask you directly, and I want you, the listener, to really pause and think about this for your own process. Are you making decisions based on the actual reality of the market, or are you just reacting to the noise of your chosen resolution?
That is the pivotal diagnostic question for any trader.
It cuts right to the core of it.
It does. If you are constantly exhausted at the end of the trading day, if you feel like you are constantly getting shaken out of trades right before they go in your direction, if you feel like you are always one step behind the market, it's very likely because you are letting the resolution setting dictate your behavior instead of letting the market dictate your process.
But the real story is, how do we practically fix this? If these time frames are an illusion, if they are psychological traps that cause us to overtrade, panic, and tie our identities to software features, how do we escape? We can't just trade without charts, right? We can't just stare at a raw tape of numbers moving up and down.
No, we don't abandon the tools. The window is still useful for looking outside. We just fundamentally reframe how we use them.
Okay, so a reframe.
To escape this illusion, you must completely restructure your approach to the market. You have to stop asking the question, which time frame should I trade?
Okay, so if I ban that question from my vocabulary right now, what is the right question I should be asking when I sit down at my desk?
The only question that matters when assessing an opportunity is, how long will this underlying process take to develop?
How long will this take to develop? Okay.
Yeah,
That immediately shifts the focus entirely away from my chart, away from my software, and puts it onto the actual idea, the actual asset.
exactly. This is what we call the campaign framework.
The campaign framework. I like the sound of that.
When you start thinking in terms of campaign, you stop thinking about isolated, frantic, one-minute skirmishes. A campaign implies deliberate planning, expected duration, and a clear, overarching objective.
So no more ping pong.
No more ping pong. And in this campaign framework, timeframes are no longer competing realities. They are no longer different cities. They are organized into a strict, unbreakable hierarchy.
All right. Lay out this hierarchy for us. Let's make this highly actionable for the listener. Walk us through exactly how to build a campaign.
It is a two-step hierarchy. Context comes first. Execution follows. That is the rule.
Context first, execution second.
Higher time frames, the daily, the weekly, the monthly, are used exclusively for context. They are not for trading. They are for understanding.
Okay, what do they help me understand?
They help you identify the phase of the macro cycle. They show you the strength of the underlying narrative. They reveal the broader direction of institutional capital flow. You use the higher time frames solely to figure out what the market is actually trying to do over the long run.
So the high time frame is the map. It shows me the topography of the terrain, the ultimate destination, where the major highways are, and where the massive mountains of resistance are located.
Yes, the map gives you your directional bias. And once you have the map deeply internalized, then, and only then, do you look at execution.
And execution is the lower time frames.
Exactly. Lower time frames, the 1 hour, the 15-minute, are strictly relegated to timing and managing your position within the context you already established.
Yeah.
They are merely the tactical details.
So if the high time frame is the map, the low time frame is just the steering wheel. It's how I physically navigate the car onto the highway I already decided to take. Let's ground this with a real-world example. Let's say we're looking at gold.
Perfect example. Let's build a gold campaign. First, context. You pull up the weekly chart for gold. You observe the macro environment.
What are we seeing on the macro?
Let's say inflation is sticky, central banks are buying record amounts of physical gold, and interest rates are poised to drop.
So all the fundamentals point up.
Right. And the weekly chart shows a massive, multi-month consolidation pattern that is finally starting to break out to the upside. The map is clearly telling you we're going north.
Got it.
The campaign is bullish, and you expect this move to take several weeks to play out.
Okay, so I know I want to be a buyer, and I know this is a multi-week campaign. I have my map. Now what?
Now you switch to execution. You know you want to buy, but you don't want to buy blindly. So you pull up your steering wheel, perhaps the 1 hour or 4 hour chart.
The lower time frames?
Right. But listen closely. You're no longer looking at these charts to figure out what to do. You already know what to do.
Because the map already told me.
Exactly. You are only looking at them to find an efficient entry point, a place where risk is low. You wait for a small pullback on the 1 hour chart, a brief pause in momentum, and you execute your buy.
But wait, here is where the psychology usually breaks down for me. Once I grab that steering wheel, once I pull up that lower time frame to execute, what's to start me from getting hypnotized by the pixels all over again?
That is the big danger.
Yeah, once the trade is live, how do I avoid micromanaging that 1 hour chart and panicking when I see a red candle? Do we really need to look at all these maps and steering wheels at the exact same time?
That is exactly where the power of filtering comes in. A low time frame signal, a 1 hour bearish crossover, a 15-minute breakdown is completely meaningless in isolation.
It's just noise.
It is just high-resolution noise. It only becomes a valid signal if it aligns with the broader process. But more importantly, once you execute, you must match your visual view to the duration of your campaign.
Meaning, once I'm in the trade, I need to put the steering wheel away.
Yes. If your context analysis told you that you are building a position for a multi-week capital flow in gold, monitoring minute-by-minute or even hour-by-hour fluctuations is not just useless, it is actively harmful.
Because it triggers the panic.
It will only serve to trigger that distortion effect, flood your brain with anxiety, and shake you out of the trade before the macro thesis even has a chance to unfold.
So if I'm driving cross-country from New York to California, I shouldn't be staring at the individual pebbles on the asphalt outside my window. I should be looking at the horizon.
Exactly. Fewer views usually lead to much clearer decisions. You do not need to look at 5 different time frames simultaneously to manage a good trade. In fact, doing so usually guarantees you will make a bad one.
So the rule is to zoom out and stay out.
Once the campaign is underway, you manage it on the time frame that reflects the campaign's duration.
So to bring this all together, what we are really talking about is a complete paradigm shift in how we interact with market data. Timeframes organize information. They do not create reality.
They are tools of observation. They're lenses. They're not expressions of truth.
The market is one continuous process. It is a single unbroken river driven by capital, narrative, and time. And the ultimate goal for anyone listening today is to switch your mindset from chart-based thinking to process-based thinking.
That is the shift from amateur to professional.
Mastery isn't about finding the magic combination of time frames. It isn't about aligning the 5-minute, the 1 hour, and the daily perfectly. It's about understanding the singular market rather than endlessly switching the lenses you use to observe it.
And as markets become increasingly complex, as algorithms become faster, and as the data feeds become richer, the retail traders and investors who succeed long-term will absolutely not be the ones with the fastest charts or the most granular data feeds.
It won't be the ones staring at the 1-second charts trying to front-run the supercomputers.
No, it will be the ones who possess the psychological discipline to step back, zoom out, and read the singular, continuous flow of the macro process.
The ones looking at the whole river.
Those who can confidently separate the noise, the resolution, from the undeniable reality of the market.
That is incredibly powerful and highly actionable. Before we wrap up today's deep dive, I want to leave you with a provocative thought. Something to deeply mull over the next time you sit down at your desk, boot up your platform, and stare at those monitors.
I love this part.
We've just spent this entire deep dive exposing how the time frames on your screen, the very things you thought were foundational to the market, are just arbitrary artificial overlays. They are abstractions that trick your brain into anxiety, overtrading, and false identities. So, if your timeframes are an illusion, what other essential tools, indicators, or lines on your dashboard are dictating your behavior instead of actually reflecting reality?
That is the exact kind of critical thinking that separates a simple mechanic from a master engineer. Always, always question the tools.
Think about those 2 screens from our intro. The screaming green 5-minute chart, the heavy red 1-hour chart. The next time you find yourself staring at them, feeling that knot in your stomach, feeling the urge to click just to relieve the tension, remember, they are just 2 different windows in the exact same house.
Just windows.
Step back from the screen, look at the bigger picture, and keep questioning the abstractions. Until next time.